If predictions really worked, millionaires would sell everything and bet on the market, but they don't. The real money comes from somewhere else. Predictions and seeds. Public versus private. Today's self-made millionaires are street smart about money and sensing economic opportunities. If they felt that market predictions could be accurately and consistently made over time, many would go out and sell their businesses, cash in their shares in law practices, and put it all in the stock market. This doesn't happen because most millionaires understand what the stock market is and what it is not. It is not something that an individual investor can control or influence. But most millionaires have a lot of control and influence over their own private businesses, their medical practices, and their law firms, and most have a well-diversified set of assets. Rarely do they place all their eggs in one basket. The stock market is one of many depositories where millionaires invest some of their dollars. But where did these dollars originate? Stock market zealots will answer that the money was earned in the market and reinvested there. If you look at the thousands of advertisements sponsored by investment companies and mutual funds, you certainly get this impression. Rarely, if ever, do they discuss the fundamental source of the wealth. They talk about the excellent return that investors in stocks and stock mutual funds have received over the years, but they rarely tell where the wealth came from. What do they exclude? A simple point. You cannot invest in the stock market if you don't earn enough money from your primary vocation to pay for more than your food, clothing, and shelter. Almost all millionaires will tell you that the seed of their wealth is their vocation. Very few are professional stock pitchers. They made their money doing other things. But what about people who have more than a few $1 million? Do decamillionaires give more credit to their investments in equities of public corporations than those with lower levels of wealth? Not really. In fact, 1 in 3 decamillionaires indicated that investing in equities of public corporations was not an important factor in explaining their economic success. Only about 1 in 5 millionaires in the $2 million to $5 million range felt the same way. On average, decamillionaires have more of their wealth invested in private or closely held stocks than they do in stocks that are traded publicly. The reverse is true for millionaires with net worths less than $10 million. See Table 2 to 7. Table 2 to 7. The investments of millionaires, publicly traded stock versus other financial assets. 1. In a similar vein, decamillionaires are less likely to credit investment advisors as a source of their economic success. Note that the term investment advisors in this context refers to those who sell and provide advice related to publicly traded stock. This is especially true for self-made millionaires. What about those who inherited their wealth? Millionaires who received at least 10% of their wealth from inheritance or gifts have a different view. About 1/2 of the inherited wealth group credited investments in public corporations and investment advisors in accounting for their economic success. But would they have been able to invest if they had no money from inheritance? On the other hand, self-made millionaires are particularly fond of private investments. They know that not all the great executives manage large public corporations. There are many extraordinarily gifted managers within the segment called private business. Attorneys are often offered equity positions in private corporations as partial or full compensation for representing these organizations. Or the principals of a small accounting firm are invited by a client to form a limited partnership, your own business. If you were able to earn several $1 million a year in your own private business, what would you do with your time and energy? Like most millionaires, you would probably focus your resources where they would generate the greatest return, your own business. But then how would you feel about the stock market, investing in the equities of public corporations? Assume that you are a successful attorney earning several $1 million per year. Your job is very demanding, with 60 to 80-hour work weeks being very common. But you cannot inventory your services. Each case and each client are different. So even if you earned $3 million last year, unless you work harder next year, you will not earn more. If you cannot inventory your services, you take another approach. You invest your earnings. Some dollars are allocated to stocks, and you hope the current value of your earnings invested this way will at least keep pace with inflation. If you can earn a decent return, that's even better. If your stock portfolio has been cranking out 30% gains in the past few years, you might even think about quitting your job as a highly successful attorney and becoming a full-time investment specialist. There are many reasons why you'll never, ever take this course of action. In your mind, being a full-time investor is not a real business. A real business has clients or customers. Sitting in a room by yourself, working at a computer screen will never generate hundreds of loyal clients. It may never make you a more marketable entity in the labor market. And you are well aware that some of the biggest public corporations make the biggest strategic mistakes. You know, because you participated in some successful lawsuits that took countless millions from these mistake makers. If you ever made mistakes like that, you'd be bankrupt. You know that your own business is much more productive than most large corporations. Your firm's sales, as well as its revenue per employee, are just two measures of superior productivity. Besides, you realize that the high returns in recent stock market history are an artifact of an inflated growth market. So you decline the market offer to close your law practice and become a day trader. Never try to do another man's job. You control your own destiny when you are a business owner or senior executive or even a self-employed physician or attorney. A multimillionaire summed it up as follows. We feel power and control. We know what we are going to do. We make decisions. It's a sense of power. You become king within reason. I have a small corporation. I go into the bathroom and we hold a board of directors meeting while shaving. Those that don't agree with me can resign. Simple, very democratic. The acid test for investment gurus. Look at it this way. Only 11% of the millionaires indicated that having excellent investment advisors was a very important factor that accounted for their financial success. In sharp contrast, 35% of the millionaires believe that making wise investments was a very important factor. That is more than 3 times as many than those who gave credit to advisors. Why so little credit to stock advisors? Although the majority of millionaires have an account with at least one full-service brokerage firm, most make their own investment decisions. Millionaires ignore or at least discount many of the suggestions generated by stockbrokers. In interviews they tell me that stockbrokers are experts at selling, and if they spend most of their time selling, that leaves little time left to study investment opportunities. As one respondent told me, if the stockbrokers could predict the future, they would never keep on being stockbrokers. They can't predict. They make money selling. But more than just the opinions of millionaires are important here. The acid test is this. Given the same levels of income within the same age group, who accumulates more wealth? Would you guess? Stockbrokers. After all, they are touted to be investment experts. In a recent survey of affluent people throughout America, 121 stockbrokers completed questionnaires. These respondents reported having annual incomes from the low 6 figures to well over $1 million. How do they compare with business owners and entrepreneurs, senior corporate executives, attorneys, and physicians who had similar incomes? In my comparison, both income and age were taken into account when making these comparisons. The older participants are expected to have accumulated more wealth. On average, age is a significant correlate of wealth. Income is also a significant correlate of net worth. For this particular dataset, the equation that was used to determine the expected net worth for each respondent is as follows. Expected net worth equals age times 0.112 times income. In other words, Mr. Edison, a business owner who is 50 years of age and has a total annual realized household income of $340,000, is expected to have a net worth of $1,904,000. Mr. Smythe, who is 45 years of age, with an income of $155,000, is expected to be worth $781,200. What if Mr. Edison actually has a net worth of at least twice the expected value? Then he would be in what I call the balance sheet affluent, BA, category. If, on the other hand, Mr. Smythe had a net worth of one-half the expected value or less, he would be categorized as income statement affluent, IA. This means that Mr. Smythe has a low level of real wealth given his age and income. The results in Table 2 to 8 tell an interesting story. Nearly 4 in 5 business owners, 77.7%, had actual net worths that exceeded the expected levels. Only 1 in 3 stockbrokers, 34.4%, had net worths that exceeded expected levels. This means that for every one stockbroker who exceeded the norm, there were 2.3 business owners who exceeded it. Table 2 to 8. Stockbrokers versus other high-income producing occupational groups. Who has more wealth? It's even more telling to compare these two high-income producing groups in terms of the balance sheet affluent, BA, criterion. BAS are those in the top quarter of wealth builders. That is, they are the best at building net worth compared to their income and age groups. In my survey, respondents who had net worths at least twice the expected level, a designated balance sheet affluent, BA. Nearly one-half the business owners, 46.3%, were balance sheet affluent, while only 13.6% of the stockbrokers were in this category. In sharp contrast, 27% of the stockbrokers were found to be in the income statement category, but only about 7% of the business owners were designated as income statement affluent. Finally, consider the ratio of BAS to IAS for the two groups. For every business owner in the IA group, bottom quarter of net worth, there are 6.6 in the BA group, top quarter. In contrast, for every 2 stockbrokers in the IA group, there is only 1 in the BA group. Could it be that many of those who aggressively sell stocks and related investments don't follow their own recommendations? If they did, 1 might expect to find more stockbrokers in the BA group. But stockbrokers made up a disproportionately high percentage of those who have big incomes yet relatively small levels of wealth. There are some outstanding stockbrokers who are balance sheet affluent types. They are not only wise about investing, they are also wise about how they spend their hard-earned money.